Hi everyone, this is Dan Stous from Flagstone Financial Management, and in today's video I'll provide an update on recent market activity and discuss how investors can not only keep perspective with what's going on, but also maybe take advantage of some opportunities that have arisen. Now, the current stock market sell-off has occurred because of concerns around recessionary impacts of tariffs and potential trade wars. A sell-off kind of started in the US and it has now gone overseas as well, with Asian markets and European markets taking a hit. But if we take a step back, it's clear that successful investing requires playing both defense and offense at different times, or potentially even in conjunction with each other. So defense means owning different types of investments or different types of assets that can withstand market conditions, changing market conditions. Whereas offense is taking advantage of opportunities that present themselves because of those changing market conditions. So over the next few minutes, we're going to discuss both. How can you play both offense or defense or both at the same time in current market environments? So let's take a look at the first chart. We can see the historical minimum, maximum, and average annual return ranges for various portfolio allocations and time periods. So let's take a look specifically at that first set of bars on the far left-hand side. So on the very far left, you see a 100% stock portfolio. What was the best one-year return for that portfolio? It was 60%. And what's the worst? Negative 40%, negative 41%. And then you take one step to the right, and that's a 60% stock, 40% bond portfolio. The best one-year return for that type of portfolio was positive 47%. The worst was negative 25%. And then so on and so forth. On the right, you see the right bar, you see positive 35% for an all bond portfolio, and negative 16% was the worst for an all bond portfolio. And that goes back to World War II. So, bottom line there, the stock heavy portfolios are a lot riskier. The bond heavy portfolios are less risky, but you still have a range of returns there. Well, if you go to the next set of bars, you look at a 5-year period. What was the average annual return over a 5-year period going back to World War II? So you can see that the range of possible returns gets compressed quite a bit. The 100% stock portfolio, the best 5-year period was positive 30 and the worst was negative 6. For bonds, you have positive 20 and negative 1 on the worst. And then on the far right chart, far right hand side of the chart, you have 20-year periods. And notably, while there are many downturns that occurred over the past century on those 1-year numbers, there have been no 20-year period since World War II where average annual declines for stocks, bonds, or diversified portfolios had negative returns. And the same is true for many asset classes during that 10-year period. So while the past is no guarantee of the future, the overall pattern here reflects the most important principles of portfolio construction. It's important to stay diversified and to maintain a longer time horizon. We don't know what the next year holds. We don't know, especially what the next day holds, but we do know that if we stay invested, the likelihood that our money is going to experience negative returns over a longer period is pretty low. This next chart shows the VIX, which is a measure of stock market volatility alongside 1-year forward returns. So it shows that volatile periods are often when the market is most attractive. This is because the VIX often spikes during sharp market drops. So the VIX is illustrated by that darker line there. And when it's high, there's a lot of investor anxiety, and it frequently precedes potential opportunities in the market. So you can see that COVID-19 spike, and then the light shaded area is what the 1-year forward returns were in the stock market, measured by the S&P 500. So you can see a really high spike in fear, and then you also see really strong returns following that. Now, that doesn't always happen, but there is some correlation here that we can observe. So Warren Buffett noted this pattern in his famous philosophy to, quote, be fearful when others are greedy and greedy when others are fearful. But while this doesn't guarantee quick rebounds or mean investors should focus on trying to time the market, it does show that even times when the market is doing poorly, those can be opportunities in the long run. So rather than retreating during downturns, investors should consider how periods like this can present attractive valuations that could warrant shifting toward instead of away from the market, depending on individual circumstances. For example, if you're a young investor or if you've got a lot of cash sitting on the sideline that you're not actually going to use in the near term, then that could be a decent opportunity for you. This is what we mean when we say playing offense. This last chart is another illustration of how playing offense might be something that's worth considering right now. So pullbacks can make valuations more attractive, which effectively means how expensive is the stock compared to how much profit that company is generating. So this chart tracks the S&P price to earnings ratio using forward earnings estimates over the next 12 months. And it shows that valuations have been driven up in recent years due to the strong market rally, but recently have begun to fall as the market has pulled back. This has made market valuations more attractive. The latest number there is 20.7, and that's on the broader stock market, but the tech and the communication and consumer discretionary sectors have even more significant compression than the broader market. So it's a reminder of the importance of diversification too. Even traditional safe havens like gold have experienced volatility, while bonds have been valuable portfolio stabilizers, helping offset declines in other asset classes. Bonds have held up really well. And for those retired clients who are taking money out of their portfolio, that's been a way to soften the blow from the stock market. So by being prepared, investors can capitalize on opportunities that emerge during periods of fear. So I want to close by speaking to a couple of groups of people. The first group is either young people who have a really, really long time horizon for their investments, or to really anybody who has just a lot of cash sitting on the sideline where you're not actually going to use that in the next year or so. Now might be a good opportunity to buy. We don't know what's going to happen in the coming days or months, but stocks are a little bit on sale right now. So if you have questions about maybe how much is appropriate or whether it's appropriate for you, we'd be happy to talk. Second group of people is retirees. Now, a lot of you, if you own bonds, you are playing defense already. Bonds have held up really well, like I mentioned earlier. And times like this is the reason that you own bonds, to provide some stability, to be able to pull money from those bonds if you're pulling money out each month. So you're already playing defense, and we kind of manage that in the background if we're helping you with your investments. So the diversification is really working right now. So I hope you found these insights helpful. If you have specific questions for us on specific types of investments or things that are unique to you, we look forward to talking with you. Don't hesitate to reach out, and thanks for watching.